Omega Healthcare stock is up 21% on the 1-year chart. But ever since late 2024, the stock is coming down quite a bit. And this stock is loved among investors because of that massive 7.3% dividend yield. And with the stock coming down quite a bit, it begs the question, is OHI stock a buy at current prices? Let's do a deep dive analysis. Right off the bat, Omega Healthcare reported a beat on FFO and revenue early February, so we're off to a great start. This company is listed since 1992 and has an enterprise value of almost 16 billion. OHI has 86 operators across 100 properties and over 92,000 beds. The thing that is standing out here is the investment grade, sitting at B-. I prefer A credit ratings, to be honest. What I really like about this company is the fact that management team is really experienced in the industry. But not only that, some of the people here work more than 15 years at the company, which is a really good sign. The company is focusing on skilled nursing, which is classified as a post-acute care, right in the middle of the average cost model. For most investors, this is what they would love to see when investing in a healthcare REIT. As of right now, occupancy rate is reported at 81%, which is a decent number, but of course I prefer above 90% here. Looking at the geo breakdown, we see that UK is the biggest with 14.2%. Usually I prefer a maximum of 10% here, but in this case I don't mind that much because it is an entire country. Looking at the WALT, short for weighted average lease term, we see that over 50% expires after 2034, which is looking pretty good for this type of company in combination with the average lease term of 9.4 years. Looking at the operator breakdown, we see that there is a nice diversification, while the biggest operators are at 10%, meaning my maximum cap. And one of the reasons why people tend to invest in healthcare REITs is because of the population that is getting older and older. It is expected that in the upcoming 20 years the 65 plus segment is increasing with 44%. Insane numbers. And because of that, it is expected there will be more demand than the industry can deliver, which means that companies like OHI are in great position. Another really important number is the net debt to EBITDA. I prefer a range of 5 to 6.5 with REITs, and this company is aiming for 4 to 5 times, which I get given the industry they are in, so this looks actually pretty good. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. Omega Healthcare is a 10 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 14, indicating they might be undervalued. Later in this video I will show you my 3 price targets for OHI stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1 billion, and in this graph we see that revenue went up in the long run, but it has its ups and downs throughout the years, and as of lately it is increasing at a decent pace again. The margins are a bit of a roller coaster, but again, as of lately it is going up pretty steady and consistently. To me this looks pretty decent. EPS is showing similar trends as the margin and the revenue. For a REIT it looks not too bad. Analysis expected in the coming 2 years EPS will increase, and quite randomly decreases in 2027. For the revenue it is looking also very interesting with decent growth numbers in the coming 3 years. But all of a sudden there is an expected 25% decrease to me this feels a bit random. Return on assets is sitting at 4%, which is a decent number for a REIT. Return on equity is also looking pretty good. And the most important number, return on invested capital, is sitting at a shy 5%, which is a decent number. It is a little higher versus the 5-year average, so that's also looking pretty good. Current ratio is at 1.28, which is a great number for a REIT. Right now, Omega Healthcare has 5 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. They have 518 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like, but it has to be said that for a REIT it doesn't look too bad. So it is still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down quite a bit in the past decade, something that happens quite easily with REITs. Shares outstanding are increasing, which is very common for REITs, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 7.3%, which is a great number. Annual payout is at $2.68 and payout ratio is around 90%, which is significantly higher versus the average for REITs. That's also the reason why the dividend isn't growing in the recent years. In here we see the dividends paid since 2015. And ever since 2020 the dividend hasn't been increased, so that's not looking that great. In this graph we see the expected dividends in 2025, 2026 and 2027. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to stay more or less flat. And overall these dividends look pretty decent to me, but how about the historical returns? I decided to compare OHI stock with the overall market, in this case the S&P 500. Next to that I added MPW and Healthpeak Properties. And on the 5-year chart we see that OHI returned 64%, outperforming all other REITs in this list. However, the S&P 500 is sitting at 127%, massively beating everyone in this list. On the 1-year chart it looks pretty good for all the 3 REITs, who are beating the S&P 500. On the 6-month chart it is a bit of a mixed result, with only MPW beating the S&P 500 with a significant difference. But OHI reports a negative 3% here. On the 1-month chart it is again MPW who's the winner, but OHI did significantly better than the S&P 500. So bottom line, the S&P 500 was by far the better investment in the past 5 years. But most recently it seems the momentum is with the REITs. So could this be the perfect time to buy Omega Healthcare stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 2, 4 and 6% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 36, 38 and 40%. And for the free cash flow margin I'm putting in 70, 71 and 72%. For the PE ratio I'm putting in 20 since it is a REIT. And for the price of free cash flow I'm putting in 12, 14 and 16. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. And right now Omega Healthcare stock is around $38. I hit analyze and we see one green number. And since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $26, with a mid price target of $33 and we have a high price target of $41. And to me the mid to high price target is the most justified here, indicating that this stock is in the middle of this range. Please let me know the price target that you think is the most justified in the comments down below. My final conclusion on OHI stock is that it is an interesting company. The industry they focus on is also really promising according to several researches. But it is also no secret that the company is struggling somewhat in consistent growth, both revenue and margins. Other than that, most fundamentals look pretty good. From a dividend point of view, things also look pretty interesting. We have a high dividend yield, but the two things that are holding me back right now are the payout ratio and the lack of growth. From a value point of view, I don't get really excited about this stock due to the lack of growth again. This is pushing my price target down significantly. And down the line, it's a really interesting company, but it's not a buy right now in my opinion. And for now, I'm putting them on my watch list and keep analyzing them from time to time. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.